Hi, everyone. My name is Will Flannigan, and I am a residential real estate agent. I'm also a certified trust and probate specialist. I'm a former attorney, and I currently am partnering with the Nell team, which led by Scott Nell at Equity Union. And I'm here today with John Dudek. Uh, John is a specialist in how you can save money, or at least how you can defer your capital gains when you sell a primary residence. And actually, when you sell any asset, John's going to talk about all those different aspects. He's going to have a slideshow for us. Um, and John is a partner at Dudek Kelly. Is that correct, John? Did I get that
Yep,
right?
that's right. Yep.
And so I'm going to let John talk, and I'll pop in with some questions along the way as John works through his presentation. But I think if you're somebody who's thinking about selling a major asset and you have a lot of accumulated capital gains from that, and John, you can talk a little bit about how that might happen, um, and what kind of capital gains hit somebody's going to face when they go to sell a primary residence. I can give you a basic example. I know somebody who bought a home in Pasadena, for example, about 40 years ago, and they paid about $300,000 for that house. That house is worth close to $3 million now. So even with their deductions and the improvements and the expenses, they're still going to be looking at a gain of about $2 million-ish, give or take. So on a $2 million gain, John, how much of that is going to be subject to federal and state capital gains?
Yeah, thanks, Will. So on a $2 million gain, you're going to be pretty much hitting the top brackets, and it's differs state by state, but obviously we're both in California. So in California, you're looking at 20% tax federally, 13.3% tax in the state of California, and then there's also a 3.8% net investment tax. Some people call it a Medicare tax, but you add on additional 3.8% of anything over 250,000. So if you add that all up, it's 37.1% is the highest tax bracket here in California, which a $2 million gain, you're looking at what, about a $750,000 in taxes that you'd have
Yeah,
to
that
pay.
hurts. That
Right.
that hurts a lot. So if you are a homeowner, a business owner, and you're thinking, man, I don't want to sell my property and give that, tax to the feds and the state. I'll just hold on to it. And when I pass away, people get what's called a step up basis, meaning their family, the people that inherit it, they get basically that tax gets eliminated because the property value gets stepped up to the current basis. And so they end up not having to pay the tax, but that's really doesn't work for a lot of people, especially if you're older and you want to retire and you want to move, sell your house. So this is a way for people to do that. So why don't you get into your presentation, John? Tell us a little bit about, who you are, who you are, your background, how you got into this very specialized area, and go ahead. We'll go from there.
Yeah, great. So thanks again for having me, Will. This is a great opportunity for me to talk to your network here about this solution. You and I have talked off camera about it, but I have an insurance background, so I've done different types of insurance throughout my career, and I found myself in a niche of working with plaintiff attorneys on people that are receiving large settlements, and there's a financial vehicle in that field that allows people to receive their settlements in a tax efficient way. And while I was kind of diving into this area of this niche area of insurance and planning, I found out that there was someone had taken this idea and applied it to the sale of an asset that was appreciated. So that means, as you said before, real estate, any type of real estate, including a primary residence, which is what we're probably going to focus mostly on today, but it can be a commercial property, investment property, vacant land, or the sale of a business. So anything that's appreciated over time, that the government is going to take that up to 37.1% if you sell it. And I just found out about this solution and I started doing research on it, and I realized that there wasn't a lot of information out in the universe, which is hard to imagine in today's day and age. There's so much information out there, but I couldn't really find anyone or anybody that was specializing in this and getting a lot of information out so that people were aware that this was a solution for them. So since then, I've been working on talking to people such as yourself, other trusted advisors, making sure that those advisors and their clients are aware that this is something that their clients can utilize in the situation where they want to sell. You mentioned there's if you get a step up in basis because a relative dies or a spouse dies, obviously that would eliminate this need. A lot of people want to exchange their property, but sometimes either they can't do a 1031 exchange or they just don't want to. They don't want to be real estate owners anymore. They want to liquidate the asset and do it in a tax efficient way. So
So
the
let me
name of
just
this,
pause you right there because some
sure.
people, they don't know what a 1031 exchange is. And a 1031 exchange applies only to commercial properties. And if you have a primary residence, that means the property that you live in, your home, you can't use a 1031 exchange unless you do a few certain things to make it into an investment property, which is kind of complicated and it's doable. But a 1031 exchange is used for somebody owns for example, they own an apartment building and they don't want to manage that or own that building anymore. They do what's called a 1031 exchange. They put the property into a qualified intermediary. The sale goes through, and then they have to. The complicated part about a 1031 exchange in a lot of cases is they have to acquire another property to keep that to allow that capital gains to be deferred and kind of rolled into the profit to be rolled into another property. Is that right? Am I getting that right?
Yes, yeah, and I am not an expert on 1031 exchanges, but I've done plenty of research on them. So yes, exactly. You're taking the equity in your property instead of receiving cash when you sell it, you put that equity into another property.
Right. And so for our cases, because I handle primary residential, this is a really unique product. I don't think people realize how special this product is, and that's why I wanted you to kind of go into the nitty gritty of how people can use a structured sale to defer their capital gains. And remember, it's not eliminating them; it's a deferred payment of capital gains. But if you do it right, it can effectively um, reduce the amount that you end up paying. Is that correct, or am I getting that wrong?
No, that's right. Yeah. At the very worst, it just defers it. So you're not paying a huge tax bill in a given year. And at the very best, it can significantly lower what you pay in capital gains taxes by by spreading out the sale, getting into lower tax brackets, and earning interest on the pre or the full sale amount of your property. And so we've got some slides and examples. I'm gonna jump in here and get the screen going. Um,
While you're doing that, I one of the questions I know that people ask, because they ask me these kind of questions before when I've talked about taxes, they want to know that this is something that has been kind of passed muster with the IRS. This is a legal loophole, if you will. And so I'm confident that it is. I don't think you would be doing something that's not been approved by the IRS. Can you talk a little bit about that?
Yeah, so the name of the transaction again is called a structured installment sale. And the if you look there in the IRS code, there's a whole section about installment sales, how they work, why they work. This is a slight variation that just basically, and I'm going to go into that on the first slide on kind of what the difference between a traditional installment sale and a structured installment sale is and why it gives the seller a little bit more security in the transaction. But you can read the IRS code; it's been in there since I think the early '80s. So it's something that's been around a long time. This is not a new idea. It's just again one not many people know about, and the slight variation that gives the seller a little bit more security. So I'm going to jump in here. This is a picture of my team. Obviously, you can see my wonderful headshot there, and then my partners Tanis Kelly and John Foley, who are not on the call today. but they work with me. Tanis is up in the Bay Area, in California and San Francisco, and John Foley is down here in Southern California. I'm located in San Diego, so we've got the whole state covered, but we can actually work nationwide. So any opportunities that come up, we're able to help throughout the United States. So this is a workshop that we put together mainly for trusted advisors. So people like yourself, Will, or financial advisors, CPAs, tax attorneys. And so we're going to go through the nitty-gritty and some technical terms of how this works. I know we don't want to drone on all day, so I'll try and keep it somewhat concise. But the objectives here, what is a structured installment sale? What's the process? What are the benefits? Why would anybody want to do this? And then talk about the Dudek Kelly model slightly. Um, and the highlights. So you can kind of see these are the different topics we're going to talk about. I won't spend too much time here. That's kind of a table of contents, but let's jump into your question that you talked about. What is this something the IRS has approved? Is this something that's been around? And the answer is yes. Again, uh, the traditional installment sale is listed in IRS Code 453, and it basically all it says is if you sell an asset that has appreciated and you take at least one payment in the tax year after the sale, you have the ability to do the installment method of accounting. So that means you sell an asset in 2026, you don't take all the proceeds that year, you take at least one payment sometime in 2027, that counts as an installment sale. And when you do that and you elect to do the installment method of accounting, you only pay a prorated capital gains on the money that you receive in a given year. So, to give a very basic example, if you decided to sell a property and you had $1 million subject to capital gains, if you took payments over 2 years instead of 1 year, instead of having a lump sum of $1 million subject to capital gains, you'd have 500,000 subject to capital gains in 2 separate years. In that same example, if you spread it out over 10 years, instead of having $1 million in year one, you'd have $100,000 subject to capital gains each year. And the reason that you may want to do that is because that can not only it allows you to pay the taxes over a number of years instead of in a lump sum, but it can significantly lower your tax bracket, which is going to lower that capital gain bill that you pay to Uncle Sam, which is what we all are out here to do. So that's the reason. That's the why you would consider this. And if we look at the difference here, you can see on the left what a traditional installment sale is. And typically, seller financing is an example of traditional installment sale. It's a two-party transaction where the buyer and the seller come together and say, let's negotiate terms where the buyer is going to pay the seller over a number of years instead of year one. And the downside of that, the upside for the seller is you get better capital gains tax treatment. The downside is that now if you've got a note from a buyer, you've got to make sure that buyer is going to pay you over 5 years, 10 years, 15 years, whatever it is. You're putting a lot of trust into that buyer. The big
Yeah.
difference now with the structured installment sale is that there's a third party life insurance carrier that's A plus rated, that's highly regulated, that takes the obligation of making those periodic payments to the seller. So that's all it is. It would be the buyer, and I'll get into the process a little bit more, but it just gives the seller some security that now I'm not worried about being paid by John Dudek over 10 years. Now I'm going to be paid by MetLife, which has been in business for 150 years and has never missed a payment. So it gives
Yeah.
me a lot more security.
That's huge. Honestly, that is huge because there are so many sellers who would love to entertain that, but then when they face the reality of, well, yeah, but if this guy, loses his job or stops paying me, then I got to take him to court. I got to foreclose on that note. It's a long process. It's going to cost me attorney fees, and yeah, I'll eventually get the asset back, but it's a pain. Banks
Right.
do it because banks have they have an institutional ability and they've already got those resources kind of built into their structure. But as an individual, you'd be kind of creating the thing from scratch, and that's really hard to do. So I wouldn't downplay that life insurance, MetLife, that is a huge element of it, and why I am looking forward to the opportunity to recommend you to somebody who might be a good fit for this, honestly.
Yeah, absolutely. And even if, they're making payments, but maybe the payments are late or, whatever it is, it's just you're kind of it's not something you want to rely on. The other nice thing too with this, you can see some of the highlights here, but this gives the seller complete control over how to structure the payments. If you're doing it with a buyer, obviously the buyer's got to agree, yes, I'll do it over 8 years or 10 years or 20 years. Um, but in the structured installment sale, the buyer's going to make a lump sum payment at the beginning of the transaction. So the money's going to be out of their hands. And so the seller now is negotiating with the life carrier and telling them basically their terms, saying, I want to take this over 13 years and 6 months because that really fits within my retirement and tax plan. And they can kind of craft their own payment schedule where they're not having to rely on the buyer whatsoever. Um, And the last point down at the bottom, because you're putting this, there's an insurance carrier involved. The money's essentially going into an insurance product that's going to pay out the seller. There is interest that's earned as well. So your money is growing over time, and it's growing pre-tax because you're getting that full sale amount or however much you want to defer into the future that's earning that interest. You're eventually going to have to pay some taxes on it, but you're getting the interest on that bigger piece of pie.
Now, John, does that interest, can I spin that interest out on a yearly basis, or do I have to roll that back into the principal for the period that I've set?
So there's a formula that's used that's spelled out in the IRS code that basically says as you're taking money over time, it's broken into really three components. There's a return of principal because you're putting the money in and you're basically just getting back your principal that you would have gotten anyways in year one. So each payment has a return of principal component, an interest component, and then a portion of that return of principal is what is subject to capital gains. And that's something where I am not a CPA, but obviously I've done a lot of research on this topic. So we put together illustrative tax projections for people with a big disclaimer that says talk to your CPA and make sure this is correct. But that is something where we can kind of break out exactly what's your return of principal, what's your interest payment, how much should be subject to capital gains, so they can make an informed decision about it.
Okay, very good.
Um, Looking at this slide, a few highlights. We mentioned this is established. It's been in the IRS code since 1980. It gets tax deferral, a hit on the customization, hit on the financial security. I'm going to say it again. MetLife is our number one partner. We also work with two other partners, Independent Life and a third-party administrator called Structures Inc. But all of them have high financial ratings. MetLife specifically, A plus rated, highly regulated, been in business since 1868 and has never missed a payment. So it gives the seller a lot of security. Simplifies the transaction. Again, you're not negotiating with the buyer. Buyer's putting their money in and they're getting out of there. And then, how we connect to Will is talking about how this works in the senior market. One thing that is very attractive for them is the guaranteed income. If they're transitioning from that primary residence and they're either downsizing, maybe they're moving out of state because they don't like California anymore. Maybe they're going into a senior living facility, an assisted living facility, whatever that is, there's a cost associated with that. And so we can project out here's exactly how much you're going to get per month for the next however long they want 5 years, 10 years, 20 years. And they can know that that money is going to be coming in every month. So big reason we think this fits well into the senior housing community.
It does. And you may not know the answer to this, but I just was thinking about this as a scenario. Can a lender use this asset in calculating the credit worthiness and essentially borrow against this settlement to qualify somebody for a loan. Like if somebody has say they have a $2 million settlement and it's sitting there and they're going to take 10% a year, but they're going to buy a $700,000 house in Texas or wherever, and they don't want to pay cash for it and they want to get a loan. I would imagine that the lender would be like, well, sure, let me give you a loan based on the fact that you're going to be getting a $200,000 distribution every year. It would seem pretty straightforward because this is a guaranteed asset. It's not like there's no speculation here. It's not subject to the stock market, right?
Correct. There is a fixed return guaranteed asset product. We do have one that has a little bit of market upside and variability if people are looking for that. But the most popular product is a fixed return. We have seen that. Obviously, it's going to be up to the lender on how much credence they give it, but person's going to have an annuity policy that guarantees payments over a certain period of time from MetLife. So lenders will take that as an asset because they know that's going to be coming in every month or every year.
Yeah, that's great.
So let's walk through the process. This is a little getting into the weeds. Again, this is mainly kind of for the high level advisor network, but I'll just kind of talk about the process on how this works and why this works and how it fits within the code. So first step, obviously, there's an asset sale. The buyer and seller execute purchase and sale agreement. There's going to be an addendum to that purchase and sale agreement that spells out there will be periodic payments involved in this transaction. That's very important for the tax code. So the buyer, in one sense, is saying, okay, I agree there will be periodic payments. Step two is the buyer assigns those periodic payment to a third party, to an assignment company that says, this is no longer my obligation to pay the seller. I've made my lump sum payment. Now it's on you to make these payments. The assignment company then purchases an annuity from a life insurance carrier, like a MetLife, like an independent life. And then there's a contract issued to the seller, which is that annuity policy I was talking about. The seller is the beneficiary of the annuity, and step five, they receive the payments from that life insurance carrier. So again, it's like negotiating a traditional installment sale, but it's just saying buyer's not going to be the one paying you. It's going to be a life insurance carrier. And so
So
it's a process that's done. Yeah, go ahead.
I know with a 1031 exchange, it's critical that the seller establish a relationship with what's called a qualified intermediary. And that party, that company, they essentially step in between the buyer and the seller prior to the close of escrow. And that's important because the IRS that 1031 exchange will fail if escrow closes and then the seller says, okay, I'm going to do a 1031 exchange. It can't because they've effectively already received the money. Uh, Even if escrow hasn't distributed the money to them, that sale has closed and the money is sitting there waiting to be distributed to the seller. So it's critical that they establish that. Now, is this similar to that? Do you have to create that contract and that relationship prior to the close of escrow?
Yes, the way I'll answer it is that we're very fortunate that we have an escrow company that has vetted this process. First American, I'm sure you've worked with them or heard of them. They're
Sure.
large player especially in California. They will act. We don't need another qualified intermediary. They just hold the funds in escrow, and then
Okay.
instead of dispersing them to the seller, they disperse them to the insurance carrier,
Got
and
it.
they understand how the process works. They've made sure it fits within their guidelines and regulations, and it's a pretty I've got great relationships here in San Diego with First American reps that know how this works, so we can make that go very smoothly.
That's good to know. It's really important because, most agents are not going to be familiar with this. And if they, for example, they choose their regular escrow company who is not familiar with how to do this, I can imagine this could get very complicated and potentially, lead to either more costs or delays or potentially failing to complete this transaction by not having the right people involved in how to structure this. So it's important that they work with somebody like you who's done these and not try to, you know, go with somebody who's kind of doing it for the first time, because this is a complex transaction in the execution, although the idea of it, I think, is fairly straightforward.
Yeah, yeah, and it like any transaction, it's complicated until you've done it, right?
Yeah.
And so I mean that's I have this later in the slides, but that is a big component of making this work is communication between sellers representatives, the insurance carrier, and then the buyer's representatives, and making sure we all understand what's happening, why it's happening, what the process is. And that's kind of my role in this transaction. A lot of people wonder, well, what do you do in this whole thing? Is I
Right.
kind of play quarterback and make sure that, Will Flannigan, you're representing the seller. We talk through everything, make sure the seller knows what's going on. We've communicated with the buyer. We've put the information in the listing that says we want to do a structured installment sale. Please only provide offers if you're willing to do this. Here's the paperwork that you would need to complete if you want to be involved in the transaction. But long story short, it's communication, making sure
Yeah.
everyone is talking and on the same page.
Well, and because I do represent buyers as well,
Hmm.
and as well as sellers, I would want to make sure that the buyer understands that, them agreeing to do the structured payments doesn't mean that they're going to be paying, through a long-term commitment to the seller. Once they make that agreement, and if they're using a lender, the lender will fund the loan just as normal. The money will go into escrow, the property will close, and they will own the property subject to the deed of trust that the bank holds. But it's no different for the buyer. They're going to have all the rights of a buyer. And once this is done, and in my understanding, once this is done and the annuity has been set up, it's no longer the responsibility of the buyer to do anything. They are now the owner of the property, free and clear, subject to their mortgage. And now the relationship is just between the seller and you guys and the annuity company, right?
Right. Yep. Buyer owns the property, just like whether it's cash or finance, they can sell it the next day. There's doesn't affect the seller in any way, shape, or form. Yeah,
Yeah,
exactly right.
and I'm only asking these questions because I know I've worked with enough buyers and people that have questions, and these are definitely going to be questions that buyers are going to want to, they're going to noodle around in their head. Well, what does this mean for me? I have to agree to what if I don't want to do an installment sale? Well, it just means that the seller is going to get money that way. It doesn't mean that you're going to continue to pay them over the next 20 years. You're going to pay your bank, you know,
Right.
and if you don't pay, then your bank is going to foreclose on you, but you don't have any more ongoing relationship with the seller. That relationship terminates when the property closes and the deed gets transferred to you. So it's important, I think, for sellers to understand that they're going to have a relationship going forward, but the buyers will not.
Right. And you hit it on the head. I mean, the buyers are the one that usually slow the deal or kill the deal because it's something new. They've never seen this. They don't know what they're signing. They just say, why do I have to go through this? It doesn't involve me. But the tax code requires that they at least sign off on it. But they, like you said, assign it away and they're not part of the transaction after
Right.
once it's done.
That's the critical thing. And, having a experienced agent help them through the process. And, you guys, I see that, your partner is also an attorney. And I'm sure that she would be happy to advise, or obviously if a buyer wants to bring in their own counsel to, educate them and advise them on the legality of it, they can do that as well. It shouldn't be a complicated conversation to have. They're just basically saying, hey, I'm assigning this obligation to do an installment to a third party, and they're going to do it, period.
Right. Yeah. And I think my partner, Tanis, we wouldn't recommend because she's part of our company that she's the one advising. But like you
Right.
said, there's plenty of very competent real estate attorneys that both you and I probably know that we could put them in touch with that are independent of us and they can get their opinion and make sure that everything passes muster.
Sure.
Okay, so I'll hit this kind of quick. Just where does this situation fit? Um, and obviously highly appreciated assets. The only properties, the only reason you do this is if the property is appreciated over a period of time. If there's been a step up in basis, it's just not necessary. You can take all the cash and not pay any taxes on it. Seniors, we hit on that earlier. We think this is a huge, huge thing for seniors that are looking to downside, move to senior communities, move to assisted living, and they're just trapped in their home. I'm down in San Diego, there's Pacific Beach, Mission Beach area. People bought homes for $100,000 35 years ago, and now they're $3 million. So they get a small exemption if they sell their primary residence, but it just isn't enough. This is a way for them to really mitigate that tax bill, turn it into a stream of income.
Yeah, absolutely. And I will just say that because I've had these conversations with seniors. They often get confused because they think that there's something in California called Prop 19. And Prop 19 will allow a senior to sell their primary residence and buy a replacement residence for the same value or a little bit less and not pay higher property tax. So that $100,000 property that they own, if they go out and they sell their property for 2 million or 3 million or whatever, they can go buy a new property for 2 million and they don't have to pay that adjusted $2 million property tax bill, which would be it's about 1.25%. So you're talking about, $25,000 plus per year in property taxes. No, they get to carry over that initial tax basis that they had on the $100,000 property, which is going to be obviously significantly less. It'll have grown over the last 30 years, but it's going to be, 10% of that amount, something like that. So
Sure.
I just want to make sure that seniors understand that what we're talking about is capital gains. And capital gains are the amount that you earn. It's no different than if you have a stock and you buy a stock, you buy Microsoft stock for whatever, $10 and you sell it for 100, you're going to pay a tax on that additional profit that you made. And this is the same thing, but this is different from Prop 19. And I just wanted to put that in there because it's often comes up. There's a confusion over the taxes that people pay or that they're obligated to pay. And that's a different animal altogether. So sorry to interrupt.
No, not at all. That's good clarification. Yeah, there's all sorts of taxes we need to pay, and so it's good to clarify what we're trying to mitigate. A few different ones I'll hit on here. If we've got people that own investment properties that don't have heirs, they're either married, they have no kids, or they're unmarried and they've got a bunch of different properties. A lot of people with kids, they'll hold on to their properties and not sell them because they want to give their kids that step up in basis when they pass away. But if you don't have that situation, why not turn your investment property into tax efficient, immediate payments? So people with no heirs, that works well. We've mentioned if you cannot do the 1031 exchange, which is investment properties only, you've got a primary residence, this is a great solution. We hit on this a little bit, but I always like to point out if you represent buyers or you are a buyer and you're going after a highly sought after property that has 5, 6, 7, 10 offers on it, why not come in with a unique solution? Say, hey, Mr. Seller, I'm willing to be the buyer in a structured installment sale. It's going to save you capital gains taxes, and I'll sign off on it. That might put you over the top and get you a property at below asking price because they're going to save so much more in taxes than they would otherwise.
It's a great
Um,
question. I didn't think of that, but that is a good play.
yeah. And then the last one at the bottom, silver divorces. We hear silver divorce numbers are up. People are living longer. They're getting sick of each other. They want to go their separate ways. Maybe they're selling their primary residence. They're selling their investment properties to kind of, do it in a amicable way. There's no step up in basis with a divorce, so you've got to pay those capital gains taxes. This is a way that you can sell it, do it in a tax efficient way. You each take your own portion of it and get paid out over time. Um, so anything there, Will, that rings any bells?
No, I hadn't thought about the divorce angle, but that is actually really relevant because you're right. You know, you're not gonna there. I do know actually there are people that I've heard of that stay married. They live separately, but they stay married because they know that within the next 5 or 10 years, one of them is going to pass away and they're going to step up basis because of the taxes. They'll actually stay legally married because they don't feel like they're ever going to marry anybody else, but they're not going to live together with that person. And it's kind of crazy to me, but people do it. People do a lot of things to avoid paying taxes, is what the bottom line is, right?
Yeah,
And when you look at really wealthy people who have access to very expensive lawyers and accountants, they've managed to manipulate the system in a way that they can take every single legal loophole uh, and avoid paying a lot of taxes. And this is just a way, I think we're introducing a vehicle for, I don't want to say middle class, because I guess it would be middle class, because if you were a teacher and you bought a home in, like I said, in Pasadena 35 40 years ago for $200,000 or $300,000, and it's worth 2.5 or $3 million now, it's not actually an uncommon scenario. So I think this is a beneficial tool that a lot of people that maybe aren't exposed to these you know different options are going to welcome and look at. And as we see the baby boom generation begin to, get into their mid 70s, and they're even in their late 70s now, this is going to become increasingly significant as an option for a lot of these people, I think. So my 2 cents
absolutely. Yeah.
about
The
the divorce,
market
that's a good idea.
used to be affordable to live in certain pockets, Southern California, and
Yeah,
that's certainly changed. So
for sure.
absolutely. I'll hit on this just very quickly. You mentioned before, we're talking about real estate, talking a lot about primary residences, but this is an option for anybody that is selling stocks in a business, or if they're 100% owner of a business, they're looking to retire, and they don't have a tax plan in place. There's not really a 1031 exchange equivalent for business owners that are selling. There are certainly tax strategies that you can implement. Talk to your financial planner, talk to your tax attorney about that. But if you're on the doorstep of retirement and you started your business from scratch and now you're selling it for 5 million bucks, guess what? That whole $5 million is subject to capital gains in most cases. So you're looking at paying over $2 million to the government. This is a way that you can spread that out, have it earn interest, and take payments over time.
Yeah, super important. There's a lot of, you know, we'll call them mom and pop businesses that are actually a lot bigger than mom and pop, but this is a good way for them to maximize the value of their asset without paying Uncle Sam more than it's his fair share.
Yeah. Hitting on some limitations. I don't want to spend too much time on this because these aren't really relevant. This is just from the tax code to make sure we kind of put that up there. But um, if you're selling a depreciable property to a related person, so if you got an investment property that you're selling to a relative, you're not able to do a structured installment sale. Publicly traded property. So a lot of people ask me, "Hey, you mentioned the Microsoft stock earlier. Can I do this with my equities, my investment, my retirement account?" You cannot do it with publicly traded stocks. So unfortunately, that's not an option. And then I think at the bottom, this one's important for those real estate investors out there. If anybody has been depreciating their property, you cannot defer the depreciation recapture. So once you make a sale, and you can hit on this a little bit, Will, if you want, but once you make a sale, anything you've depreciated, you have to recapture in the year of that sale and pay the taxes in that year. So we can't push that down the line and defer it further.
Yeah, no, I'm not going to touch that one. Uh,
Okay.
that's for your CPA or your tax lawyer to dive into, and it's probably a more nuanced discussion to have with those professionals.
It is absolutely, yeah, but it's not something. Primary residence is not as big of an issue with the investment properties. Most people will have some significant depreciation. Here are a few details just so everyone understands kind of what they're getting into. Biggest one is the payment schedule is final. This is the first question most people ask. Hey, I'm going to put this into a payment schedule. It's going to be over 10 years. What if I need the money in 5 years? Can I just pay a penalty and get my money out? And the answer is no. So that's very important that if you push this out into the future, you better be really comfortable with the length of time and the amount that you are putting into the structured installment sale. Um, to add to that, when I say that, um, when you make a sale, you do not have to put the entire sale amount into the structured installment sale. You do not have to defer it all out. So if you've got a $2 million property, you can take 500,000, 750,000 at the time of sale and just pay taxes on that and defer the rest out. So that gives you a little bit of liquidity and a little bit of flexibility on how you want to plan.
Well, I think this also circles back to that question about a lender, right? Because if somebody says, well, if I can't get my money out, what if I need to buy something or I need to, my whatever, I need $100,000, I need $400,000, whatever. Okay, if you can get a loan based on this annuity, then effectively you are getting the money out. You're just getting it out with you know, with some other obligation that you're going to pay back. But if the money spinning out every year is enough to pay those payments, it's effectively the same thing, in my opinion. I'm not a lender, but I would think whether it's a HELOC or an actual mortgage of some kind to purchase a real property, um, there is ways around that limitation. So it shouldn't be so scary to people like, oh, I can't get my money. No, this isn't. It's like people need to think of this as more like a CD, right? Than
Mm.
than this is not a a bank account or even a stock portfolio where your funds are liquid and you can get a distribution within 24 or 72 hours, whatever. You have to, and you understand why. I mean, the reason why is because they otherwise it wouldn't even be a structured sale. It would be a sale on demand, right?
Right. No, I mean that's we touched on it earlier, but there's an addendum to the purchase and sale agreement that's going to spell out exactly when you receive those payments. So that's part of the contract, which so that can't be changed after the fact from a tax standpoint.
Yeah,
Because then you
I
risk
will
having to pay back capital gains.
I will run that scenario by a couple of my friends who are lenders just to see what they say. But I think based on your experience, you've already seen that people have been able to borrow against the annuity, and that lenders are perfectly comfortable with it because it is a fixed asset that is not subject to, the fluctuations of a stock market.
Yeah, I have seen it. I'm not going to say I've seen a ton of it, but I have seen it. Again, I don't want to speak for the lenders, but it does seem pretty reasonable that if you had a fixed income guaranteed by an A+ rated carrier, they'd view that as something that they could loan against.
Sure.
Um, Going down the list, we've touched on this. The buyer has got to agree to the structured installment sale. The benefits are usually to the seller. We're usually working with sellers. So we just got to make sure as you're doing your plans, you present this the right way to potential buyers and make sure that they know what's going on throughout the process. Um, the next two, we want to introduce this prior to listing the property. This should be in the listing again. Hey, only offers that are willing to do a structured installment sale. here's the information, here's what it is, here's the tax info, here are the forms. We help you with all that. It can add 2 weeks to the process because there are, again, steps where you're filling out additional forms, similar to a 1031. There's a big stack of forms you have to fill out, but there is some time that needs to happen because we're dealing with an insurance product and they have their regulations that they need to follow in terms of suitability. So it adds a little bit of time. The minimum here is $500,000. So I think that's really important. There's no maximum, but the least amount you can put in is 500,000. Payments can last up to 50 years, which um, most people obviously are not going to want a 50-year payment plan. But if you're doing some advanced estate planning, if you're looking at leaving this to your kids, you're not necessarily needing it right away. You want it to really build up interest over a period of time. It's extremely flexible that way.
And
Um,
to clarify that, this is, so what you're saying, and I understand this to be, this is an asset that you can put into your estate plan and give to your heirs. The beneficiaries will get the same benefit of whatever the distribution plan is. It'll just go to them once you pass. So if you pick
correct. Yeah,
a
because it's an
20-year
insurance.
plan, yeah, and then you pass after year five, the remaining 15 years, they're going to continue to get that money. However, the heirs are, being divided. If there's three kids and they're each getting a third, it's still going to go out that way.
Exactly right. Yeah. The seller has complete control over who they name as the beneficiaries. It's done at the time of the sale, but then you can change it anytime you want, just like any other insurance product. So
Right.
it is something that it's going to pay out. If something happens to the seller, God forbid, it'll go to their beneficiaries.
And I would think that because you have named beneficiaries, even if you failed to, I can't imagine somebody would do this, but if you failed to add this to a, your trust, and it didn't go into the trust, it would still be distributed to them because it is a named beneficiary. And is that correct?
Yeah, I mean, whoever's name, they're going to ask for name, social security number, address, and all that. So if it's not named to a trust, it'll just go to that person directly, and then it's up to the estate planners and attorneys to figure out how it works
Sure.
within that family. But yeah, the money's going to be paid out to whoever is listed on the beneficiary form.
Okay.
And then we've mentioned backed by A+ rated life insurance markets. Just one of the safest places you can put your money are these large financial institutions.
And I see guaranteed payments regardless of market conditions. What kind of payments are coming out now and what are they guaranteed to be? And does it fluctuate depending on
Yeah,
the
it's tied.
product?
It for there's two ways we can do it. I mentioned so there's a fixed guaranteed rate of return that's going to be tied pretty closely to what a 10-year treasury return is going to be. So over 10 years, we're looking at around 4% rate of return, um, which is
Tax free.
not well tax free, right? It's on the pre-tax amount. Well, I shouldn't say tax free. It's on the pre-tax amount, and you're taxed on it when you receive it. But
Right.
the 4% is not going to knock anyone's socks off. But the reason most people do this is to mitigate the capital gains taxes. The
Sure.
return they get on it is the cherry on top. And then there is an option if somebody wants to put this into an indexed annuity, something that's tied to the S&P 500 or the NASDAQ that you can make only so much, but you've got downside protection based on how that index performs. We do have that option available as well.
Okay. And I'm sure people can explore that when they get a conversation going with you.
Right. Yeah, we walk through all those options and show you the numbers and make sure you know what those rates of return are, and that's all part of the process. So, going to go through a case study here. Senior example. We've got an 80-year-old who's experiencing health issues, would like to move to assisted living. Home was originally bought for $150,000 in 1982. The husband passed away unexpectedly in 2005, so there was a step up in basis at that time to 625,000. But now the home's worth 2 million, and there's a concern about the long-term capital gains. And so this is a little table we put together, but the long and short of it is once we put in all the factors of closing costs and the IRS exclusion, we're looking at selling the property for $2 million. And the basis that we use to calculate capital gains is $1 million. So with $1 million subject to capital gains, as we said before, as much as 371,000 would be due if you took this in a lump sum payment. So what does this look like with the structured installment sale? And this might be a little hard to follow all these numbers, but basically you can see if this is spread out over 10 years, each year you would receive $200,000 in principal. There'd be $40,000, 40,500 of interest that the annuity is paying. So that's the interest you're earning for a total payment of $240,500 every single year. $100,000 of that is going to be subject to capital gains. And as I said at the very beginning, if you're, and there's going to be a slide with tax brackets on it. I won't go too deep into it, but if you have $1 million in 1 year compared to $100,000 in 10 years, you're going to be in a much lower tax bracket. It's going to save you a lot of money just by spreading that out. You go to the end, your $2 million investment, if you look at the total payment, has paid out 2,400,000, just a little bit over that. And you've got the $1 million subject to capital gains, but you've split it up into 10 different years. And if we look at those tax brackets, this is probably a little tough to read, but federal tax brackets, if you're over 600,000, you're paying 20% for federal capital gains. If you're just over 100,000, you're paying 15%. If you're under 100,000, you're paying 0%. So again, I don't want to get too deep into the numbers, but by moving from $1 million to 100,000, you're wiping out nearly 20% in federal capital gains. You're going about 5 to 6% in California state capital gains, and then the net investment tax of 3.8%, you're wiping that out completely. So a significant tax savings.
That's a lot.
Yeah. And I'm a numbers guy. I like to dive into that stuff, which is why it's in the proposal. So if you have someone that wants to get in and see how that would actually look, we run a projection for you. So here are our insurance partners. I've mentioned MetLife, Independent Life, and Structures. They all have slightly different product offerings. So the point of this is, depending on what you are looking for, we've got a solution that can usually fit your financial profile. Here's a few testimonials that talk about how wonderful we are, and that's it. This is where we get to the Q&A section. So I think we've done a good job of that. But Will, if you have any other follow-up questions, I'm happy to answer them.
No, I think if you want to reduce that Q&A,
Sure.
so I think that you covered the basics and then some for somebody who's just getting introduced to this. I would say anybody who's watching this video, if you have a specific question about this settlement, reach out directly to John. John, what's your phone number?
It's
Okay.
401, and hopefully we can put this in the description of the video, but my cell phone is 401 524 4022.
Okay.
And my email is just my first initial last name, jdudek at dudekkelly, KELLY.com.
Yeah, and they can find more information on your website, dudekkelly.com, and you talk through a lot of this stuff. So I think if you have a specific questions about the product, how it works, I think you've got a chance to get a feel for John and how patient and thorough he is, and he'll be a good resource for you. If you have a specific question about your property and what it might be worth, or how you might prepare for this upcoming sale, and you want to talk to me about this, and just understand there's not a lot of realtors who even know about this product and can walk you through the steps, who work with somebody like John. I'm a former attorney, and I actually was getting my master's in in law at the University of Washington as a tax lawyer many years ago, and I realized halfway through the program that I didn't like taxes that much, so I stopped doing that. But I have a better than I'm not a tax lawyer by any stretch. I'm certainly not a CPA. I don't really like taxes, but I have a better understanding than a lot of realtors. So if you do have questions about real estate and how you can, minimize your tax burden, feel free to reach out to me directly. And of course, I'd be happy to put you in touch with John if you have any additional questions. Um, but I think that we've covered most of it, and I just want to leave people with um, you know, with the idea that you don't need to necessarily just do the easiest thing, which is just to sell your house and pay the tax. It's easy, but it's not necessarily the smartest thing to do. This might not work for everybody, but for I think many people, this is a good option that they should at least um, explore before they go down that road and pay that 37.1%. Which that tax hit can be very big. And as you think about your legacy, you think about your kids or your grandkids, that's a big chunk of change you've just added. In your example, you essentially added $400,000 to the asset over a 10-year period that they would not have got, in addition to the reduced tax basis that they're paying. So again, you're a numbers guy. You could probably talk them more through it. I'm probably butchering the analysis of how the financial benefits of it, but it's a great tool. John, do you have anything you'd like to close with?
No, I just want to thank you again and reiterate what you've said. Very few realtors out there know about this. Very few understand it. So working with someone like you, Will, makes the process go a lot more smoothly. And so I just again want to thank you for having me on and allowing me to talk to your audience. It's been great.
Of course. Thank you so much. And again, I'm going to put, I don't have it on here now, but I'm going to put our contact information. My number, if anybody wants to call me direct, my cell is 310-920-1108. You can email me at flanniganhomes. My name is spelled there on the screen, flanniganhomes@gmail.com. And you can also go to my website, willflanniganrealestate.com. So thank you again, John, for taking the time to walk us through this, and have a great day. And I look forward to talking to you again.
Thanks so much, Will.
Sure.